Welcome to our channel, where we break down timeless investing wisdom from the world's greatest minds. In today's video, we focus on one of the most misunderstood yet most important topics in investing, risk management, through the lens of Warren Buffett. This is not about chasing quick profits or predicting the market. This is about learning how Buffett thinks about protecting capital first, so wealth can grow naturally over time. Let's begin. Warren Buffett's core view on risk. Warren Buffett has repeatedly said that risk does not come from volatility. In his view, the real risk in investing comes from not knowing what you are doing. This single idea sits at the foundation of his entire investment philosophy. Buffett does not see risk as day-to-day price movements. He sees risk as the permanent loss of capital. If money is lost in a way that cannot be recovered, that is real risk. Temporary declines, market crashes, or negative headlines do not automatically mean danger, unless the underlying business is weak or misunderstood. One of Buffett's most famous principles is simple. Rule number 1. Never lose money. Rule no. 2. Never forget rule no. 1. This does not mean he has never experienced losses on paper. It means he structures his decisions to avoid situations where loss becomes unavoidable. Buffett manages risk by staying within his circle of competence. He only invests in businesses he can clearly understand, how they make money, why customers stay loyal, what could realistically go wrong, and how strong the company will be 10 or 20 years from now. Anything outside this understanding is considered risky, no matter how popular or exciting it looks. Another key idea is simplicity over complexity. Buffett avoids complicated financial instruments, excessive leverage, and businesses that depend on perfect conditions to survive. Complexity increases uncertainty, and uncertainty increases risk. Simple, durable businesses reduce both. Buffett also believes that time is the friend of good businesses and the enemy of bad ones. If a company has strong fundamentals, temporary market drops do not destroy value, they often create opportunity. But weak businesses are exposed over time, regardless of how good they look in the short term. Cash plays a major role in Buffett's risk management. He is comfortable holding large amounts of cash when opportunities are not attractive. For him, doing nothing is often safer than doing something unnecessary. Cash provides flexibility, safety, and the ability to act decisively when real value appears. Buffett also avoids debt at the personal and investment level. He understands that leverage magnifies mistakes. Even a great business can fail if debt forces bad decisions during hard times. By minimizing debt, he reduces the chance of being forced into losses. In Buffett's framework, risk management is not about prediction. It is about preparation. He assumes markets will panic, recessions will happen, and mistakes will occur. His system is built to survive those events, not avoid them. Most importantly, Buffett manages risk emotionally. He does not react to fear, noise, or market euphoria. Emotional discipline protects investors from their own worst decisions. In Buffett's view, losing control of emotions is often more dangerous than any economic downturn. This mindset, understanding risk as ignorance, avoiding complexity, staying patient, protecting capital, and maintaining emotional discipline, forms the foundation of how Warren Buffett manages risk in investing. How Buffett reduces risk through business quality and margin of safety. For Warren Buffett, risk management goes far beyond simply avoiding bad investments. It is about building multiple layers of protection into every decision. 2 of the most important layers he relies on are business quality and the margin of safety. Together, these act like a shield against uncertainty, mistakes, and unpredictable markets. Buffett believes that the quality of a business is the first line of defense against risk. A high-quality business can survive recessions, competition, technological change, and even management errors better than an average company. These businesses usually share common traits: strong brand recognition, loyal customers, consistent demand, and the ability to raise prices without losing customers. This pricing power is critical. When a company can increase prices to keep up with inflation or rising costs, it protects profits over time. Businesses without pricing power are far riskier because they depend on perfect conditions to remain profitable. Buffett prefers companies where customers barely notice price increases because the product or service is deeply embedded in daily life. Another key factor is predictable earnings. Buffett avoids businesses whose profits swing wildly based on external factors like commodity prices, fashion trends, or short-term cycles. Predictability reduces risk because it allows long-term planning. If future cash flows can be reasonably estimated, uncertainty drops dramatically. Buffett also pays close attention to competitive advantages, often called economic moats. These moats protect a business from competitors and reduce the risk of profit erosion. Moats can come from brand strength, cost advantages, network effects, regulatory barriers, or customer switching costs. Without a moat, even a successful company can be attacked and weakened over time. Management quality is another major risk factor. Buffett looks for leaders who act like owners, allocate capital wisely, and think long-term. Poor management can destroy even the strongest business. Honest communication, disciplined decision-making, and respect for shareholders all reduce long-term risk. Once Buffett finds a great business, he still does not invest blindly. This is where the margin of safety comes in. The margin of safety means buying a business at a price significantly below its true value. This gap protects the investor if assumptions turn out to be slightly wrong or unexpected problems arise. The idea comes from Benjamin Graham, Buffett's mentor. Markets are emotional and often misprice assets. By waiting patiently for undervaluation, Buffett reduces the downside while keeping the upside intact. If the business performs well, returns can be strong. If it struggles temporarily, the lower purchase price absorbs the shock. Buffett is very clear that price matters. Even the best business can be a bad investment if bought at the wrong price. Overpaying removes the margin of safety and turns quality into risk. This is why Buffett is often inactive for long periods. He refuses to compromise on valuation. He also understands that mistakes are inevitable. The margin of safety is not about being perfect, it is about surviving imperfection. Investing with no room for error is gambling. Investing with a margin of safety is risk control. Another overlooked aspect is concentration. Buffett is willing to concentrate capital into a small number of high-conviction ideas. This may seem risky, but in his framework it actually reduces risk because he deeply understands each position. Diversification into unfamiliar businesses can increase risk if it spreads attention too thin. Buffett also avoids short-term forecasts. He does not rely on interest rate predictions, economic cycles, or political outcomes. These variables are unpredictable and introduce unnecessary risk. Instead, he focuses on what he can control: business strength, valuation, and time horizon. In Buffett's view, risk is not eliminated by activity. It is eliminated by discipline. Waiting, studying, and refusing mediocre opportunities is a form of risk management that most investors underestimate. Time horizon, patience, and emotional control, Buffett's hidden risk shield. For Warren Buffett, one of the most powerful tools of risk management is time itself. While most investors think risk comes from holding investments too long, Buffett believes the opposite. The shorter your time horizon, the higher your risk. Markets fluctuate wildly in the short term, driven by fear, greed, headlines, and speculation. Over long periods, however, business fundamentals tend to dominate. Buffett manages risk by extending his time horizon far beyond that of the average investor. He does not buy stocks thinking about where prices will be next month or next year. He buys businesses assuming he may hold them for decades, or forever. This long-term mindset dramatically reduces the impact of short-term volatility, which Buffett sees as noise rather than danger. He often says that if you are not willing to own a stock for 10 years, you should not own it for 10 minutes. This statement reflects a core belief. True risk is not price fluctuation, but permanent loss of capital. Short-term price drops are not risky if the underlying business remains strong. Panic selling during these drops is what converts volatility into real loss. Patience is therefore central to Buffett's risk management philosophy. He waits patiently for the right opportunity, sometimes holding large amounts of cash for years. To many investors, cash feels unproductive or even risky because it earns little return. To Buffett, cash is strategic safety. It gives flexibility, protects against forced selling, and provides ammunition when markets crash and opportunities appear. Buffett's patience also applies after buying. He does not constantly monitor prices or react to daily market movements. Frequent trading increases risk through transaction costs, taxes, emotional mistakes, and poor timing. By doing less, Buffett avoids many of the errors that destroy investor returns. Emotional control is another pillar of Buffett's risk strategy. He understands that markets are emotional systems. Fear spreads faster than facts, and greed can blind investors to danger. Buffett deliberately positions himself on the opposite side of crowd psychology. When others are fearful, he looks for value. When others are euphoric, he becomes cautious. He famously advises investors to be fearful when others are greedy and greedy when others are fearful. This is not a slogan, it is a risk management principle. Crowds tend to overreact in both directions, creating mispricing. Following the crowd exposes investors to peak risk, while resisting it often reduces risk. Buffett avoids environments that amplify emotional mistakes. He does not watch financial news obsessively, track minute-by-minute price changes, or engage in online speculation. These activities increase emotional pressure and lead to impulsive decisions. Instead, he focuses on reading, analysis, and long-term thinking. Another important aspect is decision simplicity. Buffett reduces risk by simplifying choices. He does not invest in complex financial instruments he cannot fully understand. Complexity hides risk. The more complicated an investment is, the harder it becomes to identify where things can go wrong. Simplicity allows clearer judgment and faster recognition of mistakes. Buffett also avoids leverage. Debt magnifies returns, but it magnifies losses even more. Leverage turns temporary problems into permanent disasters. Many investors fail not because their ideas were wrong, but because they were forced to sell at the worst possible time due to debt. Buffett prefers a structure where he never has to sell under pressure. Time also works as a risk reducer through compounding. High-quality businesses that reinvest earnings effectively tend to grow stronger over time. Competitive advantages widen, brands deepen, and cash flows become more resilient. As time passes, risk often declines rather than increases, provided the original business was strong. Buffett understands that doing nothing is often the hardest discipline. Inactive periods feel uncomfortable, especially when others appear to be making quick gains. But activity for the sake of activity is dangerous. Buffett's restraint protects him from chasing trends, bubbles, and narratives that later collapse. He also separates process from outcome. A good decision can have a bad short-term outcome, and a bad decision can have a lucky outcome. Buffett judges risk by the quality of the decision-making process, not by short-term results. This mindset prevents emotional overreaction and reinforces discipline. Finally, Buffett accepts uncertainty. He does not try to eliminate it, he plans around it. By using long-time horizons, patience, emotional control, simplicity, and strong businesses, he creates a system where uncertainty becomes manageable rather than threatening. Building a complete risk management framework, how Buffett puts it all together. In the final layer of Warren Buffett's approach to risk management, everything connects into one disciplined system. Buffett does not rely on a single rule or trick. He combines mindset, analysis, structure, and behavior into a framework that protects capital across decades. This is why his success is not accidental, it is engineered to survive uncertainty, crises, and change. At the core of this framework is business-first thinking. Buffett never asks, "Is this stock risky?" He asks, "Is this business risky?" Stocks fluctuate every day, but businesses operate in the real world. By focusing on how a company earns money, how stable its customers are, how predictable its costs are, and how strong its competitive position is, Buffett shifts risk analysis away from the stock market and into economic reality. He evaluates risk across multiple dimensions at once. Financial strength is one dimension, strong balance sheets, manageable debt, and consistent cash flows reduce fragility. Competitive strength is another, companies with strong brands, cost advantages, or network effects face fewer threats. Management quality is another, honest, capable leaders reduce operational and ethical risk. No single factor is enough on its own. Together, they form layers of protection. Buffett also manages risk by concentration with conviction, not diversification out of fear. While many investors spread money across dozens of holdings to reduce risk, Buffett believes excessive diversification can increase risk by lowering understanding. He prefers to invest more heavily in a smaller number of businesses he understands deeply. Knowledge, in his view, is a form of risk control. This does not mean reckless concentration. Buffett only concentrates when the margin of safety is wide, the business quality is exceptional, and the long-term outlook is clear. When these conditions are not met, he is willing to stay in cash. The ability to wait is itself a risk management advantage. Another critical element is structural resilience. Buffett designs his investing life so that he never faces forced decisions. He avoids short-term obligations, margin calls, and liquidity pressures. This allows him to hold through market crashes calmly, while others are forced to sell. Many investors fail not because their investments were bad, but because their structure was fragile. Buffett also understands that risk is asymmetric. Losses hurt more than gains help. A 50% loss requires a 100% gain to recover. Because of this, his framework prioritizes avoiding large losses over chasing high returns. He is willing to miss opportunities if they carry the possibility of permanent damage. He manages risk by being selective about the environment he operates in. Buffett avoids sectors where outcomes depend on rapid technological change, unpredictable regulation, or binary events. Not because profit is impossible there, but because uncertainty is harder to measure. He prefers industries with long histories, stable demand, and slow evolution, where risk can be reasonably estimated. Buffett also incorporates behavioral self-awareness into his framework. He knows his own limits. He does not pretend to be smarter than the market in every area. Instead, he stays within his circle of competence. This humility is a risk management tool. Overconfidence is one of the most common causes of catastrophic loss. Importantly, Buffett separates risk from reputation and popularity. He is comfortable being wrong temporarily and unpopular for long periods. This allows him to avoid herd behavior. Many investors take risk simply to avoid looking different. Buffett takes reputational discomfort to reduce financial risk. Another layer is rule-based discipline. Buffett's rules are simple but strict. Don't lose money, don't invest in what you don't understand, demand a margin of safety, and think long-term. These rules limit emotional improvisation. In stressful moments, rules protect investors from themselves. He also continuously reassesses risk after investing. Buying a great business does not eliminate risk forever. Buffett monitors whether the original reasons for investing still hold. If the business model weakens, management changes for the worse, or competitive advantages erode, risk increases, and he is willing to act. Yet, he avoids constant tinkering. Monitoring does not mean trading. It means understanding whether the long-term story is intact. This balance between vigilance and patience is rare, but essential. Ultimately, Buffett's risk management framework is about control over outcomes, not predictions. He does not try to forecast markets, interest rates, or economic cycles. He builds a system where even if forecasts are wrong, the damage is limited. For ordinary investors, this framework offers a powerful lesson. Risk management is not about avoiding all risk. It is about choosing the right risks, structuring your decisions to survive mistakes, and staying disciplined when emotions are strongest. This is how Warren Buffett has protected capital for generations, not by avoiding uncertainty, but by mastering how to live with it safely. The ultimate lesson: risk management is a way of thinking. Warren Buffett's greatest contribution to investing is not a formula, a ratio, or a secret technique. It is a way of thinking about risk that reshapes how decisions are made. In this final part, the most important insight becomes clear. For Buffett, risk management is not something you do after choosing an investment, it is something you practice before, during, and after every decision. Buffett believes that most investors misunderstand risk because they define it as volatility. Prices moving up and down create fear, but that fear is often misplaced. True risk, in Buffett's view, is the possibility of permanent capital loss. If you buy a strong business at a sensible price and hold it through temporary market declines, volatility becomes irrelevant. But if you buy a weak business, no amount of price stability can protect you. This is why Buffett's first and most famous rule exists: don't lose money. The second rule, don't forget the first rule, is not a joke. It reflects the idea that avoiding big mistakes matters more than making brilliant moves. One major loss can erase years of steady progress. Buffett also teaches that risk increases when investors chase what they do not understand. Complexity creates blind spots. Financial products that promise high returns often hide fragile assumptions. Buffett avoids them not because he lacks intelligence, but because he values clarity. Simplicity is a form of safety. Another core lesson is patience. Buffett sees time as a risk-reducing force, not a risk. When you own a high-quality business, time allows compounding to work, management to execute, and competitive advantages to strengthen. Impatience, on the other hand, forces bad timing decisions and emotional reactions. Many investors create their own risk by demanding quick results. Buffett's approach also reframes courage. True courage in investing is not buying during hype, it is holding during fear. Markets will test conviction repeatedly. Buffett prepares for this by investing only when he is confident enough to remain calm under pressure. If he cannot sleep peacefully owning an investment, it is already too risky. He also emphasizes personal responsibility. Buffett never blames markets, governments, or other investors for losses. Every investment decision is owned fully. This mindset forces better risk assessment upfront and discourages reckless behavior. Importantly, Buffett accepts that mistakes are inevitable. Risk management is not about being perfect, it is about survivability. If mistakes do not destroy your capital, you can recover and learn. His entire system is designed to keep mistakes small and manageable. Buffett's life demonstrates that risk management is deeply connected to temperament. Intelligence matters, but emotional control matters more. Investors who panic, overreact, or seek constant excitement expose themselves to unnecessary danger. Calm decision-making, guided by clear principles, dramatically lowers risk over time. For modern investors, the lesson is powerful and practical. You do not need complex models or constant market activity. You need discipline, patience, understanding, and respect for uncertainty. You need to structure your financial life so that you are never forced into bad decisions. In the end, Warren Buffett's approach to risk management is about protecting your future self. Every careful decision today is a gift to the person you will be years from now. By focusing on what can go wrong, and building defenses before it happens, Buffett has shown that long-term success is not about predicting the future, but about being prepared for it. This is why his philosophy endures. Markets change, technologies evolve, and economies rise and fall. But disciplined risk management, grounded in common sense and human behavior, remains timeless.